Coming up today, stocks stage a wild day of trading. Are we about to get even more tariffs? Wall Street pushes back. How much further do we have to fall? The Fed holds a closed door meeting. And my theory on why this is all really happening, which may surprise you. It's a historic week in the market, guys. Let's go. It was yet another crazy day in the stock market. However, just looking at the heat map, it wouldn't appear that way. S&P 500 actually finished pretty much flat today, with plenty of mixed breadth across the board. But just look at some of these daily candles we just printed here on the SPY. Like I said, we pretty much finished flat, but the daily high-low range just on the S&P 500 was almost 9%. And just looking at the NASDAQ Qs, we actually had a daily low to high range of over 10%. That is huge. A range that can normally take weeks or even several months to form just happened in today's regular trading session alone. And what a monster gap down it was pre-market. Now got the Russell 2000 hitting a drawdown of 30% from highs. Remember, S&P 500 was only at all-time highs 6 weeks ago, just back on the 19th of Feb. And this has been one of the most fastest and sharpest declines we've ever seen in market history. So I know as investors, our portfolios are all taking a bit of a hit here. However, if you didn't blow up today, give yourself a pat on the back because you just survived one of the craziest days in the market ever. And stick with me today because later on in this video, I'll show you some option trades I took on the E-mini S&P 500 futures options as soon as the futures markets opened last night. You won't believe the implied volatilities that I sold options at. I'll show you the actual fills I got from right inside my brokerage account, and I'll explain to you my thinking on what led me to make these trades, as it's something I haven't really ever seen before. I also spent the weekend immersed in all of this, reading and watching as many videos as I could, interviews with prominent fund managers, looking at all the data and thinking about it. And so I'm going to share all of that with you in this video, along with providing you my interesting theory on what I really think the White House's strategy is here, and what could happen going forward if I'm right. I think you'll find that really interesting. But a big difference between this crisis and past financial crises is in prior ones, the government and the Fed were actively trying to stem the bleeding, give us that put. Whereas this time, it's almost like we've got the opposite, and hence why many long-time fund managers are saying they've never seen anything like this before in their entire careers. The floor's just completely given out of the markets, and the whole global economy has been shocked practically overnight. And where all the dominoes fall is still anybody's guess. We had the VIX open up at 60 today, and the VIX 9-day, which measures implied volatilities of short-term options, actually shot up to 73 today, some of the highest levels you'll ever see. And just looking at the term structure, still a very steep backwardation. Front month, 18% above the second month. And just going out to a monthly chart on this spread, that's almost as high as we've seen before in history. Typically, volatility can peak out here. We have seen it go higher back in March 2020 and October 08, the height of the GFC. But prior instances, like Volmageddon 2018, we peaked out at this level. Same with the big hedge fund unwind in August 15 and Europe debt crisis in August 11. Similar fear spikes in volatility that we've got now. And what happened with government bond yields? My gosh, just as impressive move, if not maybe even more than what's going on in the stock market. 10-year opened at 389, finished at 420, and a huge steepening of the curve, with the 10-year moving up 20 basis points versus only 8 basis points for one-year bond. And so there's many theories being thrown around here. Forced selling, as we can see TLT came off massively today. Bonds getting slammed on huge volume on what should have been a flight to safety. Fears of recession, yields should have come down. Or is it China dumping US bonds, causing yields to spike? Maybe they're doing a little selling, as they have been for years, trying to deleverage from the States. But if that were the case today, I would have expected the US dollar to come off hard as well. It didn't, actually pushed up a bit. And what that tells me is there may have been a bit of flight to safety to T-bills. But yield spiking on the back end could be the market telling us it's more worried about inflation than a recession. But more on that later. And in a minute, I'll present to you my theory of what's really going on here. But just looking at the fear and greed index, no surprise to see that still at rock bottom at 4. I think we've only gone lower once than this before in the depths of March 2020 and maybe once in the GFC, but pretty much as low as you'll see it. And coming in this morning, S&P was down over 4%, in fact 5% at one point. And if we were to finish down more than 4% today, that would have been 3 straight days down 4% or more. Something we haven't seen since the Great Depression 100 years ago, just after they also enacted a similar level of extreme tariffs. And so we're getting similar technical patterns that we've seen in prior crashes, 1987, and the biggest bear market in US stocks ever after the bubble popped in 29. Dow Jones fell over 80% in the next couple of years. Don't think tariffs really helped it out. But is this time going to be different, or are we still going to get a bounce like we've seen in history? But just looking at some research from Goldman Sachs and the percentiles of sentiment indicators for data going back over the last 18 years, we're at extremes for risk-off mood, pretty much the lowest we've ever seen, which could indicate we're getting close to capitulation if we haven't seen it already this morning. And here's some more interesting data for you. Looking at S&P 500 3-year analog analysis. A very cool comparison coming out of Nautilus Research, showing historic historical periods that have greater than a 50% correlation to the current 3-year pattern. And just looking at the forward returns in the 20 times that's happened over the last 100 years, not all that great, actually. 1 year later, the market was up 11 times, 9 times it was lower. However, there's a look at a composite of the 3-year analog and see how sharply we've diverged from a typical consolidation. And just scrolling down, looking at the red line, which is the S&P 500 currently versus 1956, there's 1937, 1998 actually looks one of the most similar to the current price action. We had a big pullback in the markets in 98. LTCM blowing up, there was trouble in Asia. Everyone thought the bull was done for sure. Nasdaq went on to double again going into March 2000. We also got a very similar look to 1946 before it kind of went into a kangaroo market. I think that's very much a possibility here. But we had a similar sharp spike in late 18, as that was a year of tariff-induced volatility as well. Looking at some others, 2007, eerily similar. Can't rule out that possibility either. Nor can we in 1981, but who knows, 1990, 1994 also looks similar, and there's a look at a few others. 2011, 1972, there was a big bear market going into 74. But is this about to get a whole lot worse? Ever since we got presented with those huge reciprocal tariffs last Wednesday afternoon, the market tanked and then that accelerated going into the weekend on the back of China biting back, eye for an eye. They slapped 34% tariffs back on US goods. Now the US president's come out and raising the stakes even further, saying they didn't acknowledge his warning for abusing countries not to retaliate. And also posting today that if China doesn't withdraw its 34% increase above their already long-term trading abuses by tomorrow, the states will impose additional tariffs on China of 50% effective April 9th. Additionally, all talks with China concerning their requested meetings with us will be terminated. Negotiations with other countries, which have also requested meetings, will begin taking place immediately. But you got to understand, China is trying to position themselves as the new leader in a new world order. They want to overtake the states in terms of economic and military dominance. They're not going to bow down to the US president. Pretty sure he knows that. And that's why I think we've got a bit of game theory going on. A theoretical framework for conceiving social situations among competing players. The White House just laid out a whole new game. However, my theory is the real reason for extreme upfront tariff. Because these numbers are crazy. I don't think they're sustainable for the world, including the US. It's going to massively increase prices for Americans. Such a dramatic change to how the world has developed over the last 50 years. And let's be honest, how many Americans want to start working in a factory making clothes? The need for low-cost labor is going to be around for a few more years before the robots can come in over the next decade. And so the whole theory of trying to bring all manufacturing back to the States to create jobs, I think is a little flawed because the cost of US labor simply can't compete even after these tariffs with Southeast Asia, not to mention, like I said, robotics ramping up. So what do I think this is all really about? And don't get me wrong, there is a justified need for a global reset. I have no doubt the White House wants to reindustrialize the states. There have been some abuses abroad, and the states can definitely negotiate themselves into a better position going forward. However, I think the real reason for these extreme upfront tariffs is it's mostly about China, which it's no coincidence is shown at the top of the board. Remember, they got 34% tariffs slapped on top of the already existing 20%, staring down the barrel of 54%, with the president just threatening to dial it up another 50%, which he very well may do. But look who else is up the top. Yes, the European Union, but also Vietnam, Taiwan, India, Thailand, Indonesia, and Malaysia. These are low-cost labor countries that also do a lot of manufacturing. But they're not really a threat to the US. Neither is the EU or Japan. Nor is Russia, Iran, or North Korea. Those economies are tiny. The real threat is China. They're on a path to overtake the states, the size of their economy, and military as well, potentially within the next 5 to 10 years. The new president doesn't want to help finance that. So my theory is they've put the heat on these other low-cost producing countries to induce them into making deals, which it looks like they're already coming to the table. And I believe the US will win these negotiations with much more favorable outcomes than what's been in place for decades. And not only potentially get US tariffs down to zero, but also remove additional trade barriers from exporting American technology into these other low-cost producing countries to help lift them off the ground whilst also making a profit, but more importantly, shifting global manufacturing and production to all other low-cost countries, including Brazil, away from China, taking away their big advantage. Manufacturing, for which they also benefit from having a fixed currency. They determine the valuation of their currency, which is manipulated to make their exports more appealing. Pretty much the rest of the trading world has free floating currencies determined by the market. So I believe the tariffs on China are likely to remain and the others will be relieved, and that'll incentivize US companies which have already started this. Nike's already producing half of their shoes in Vietnam to shift more and more of their production to Vietnam, Thailand, Malaysia, Indonesia, Brazil. And so I think these extreme upfront tariffs coming out of the White House creates a strategic interaction. where players, or countries in this case, make decisions that consider the actions and reactions of others. I don't think the president's tariff strategy is just about being punishment. I think it's a calculated move to shift the balance of manufacturing power. Pressuring China, nudging its replacements, that is a strategic deterrence. Unfortunately, if I'm right and China wakes up to all of this, it could motivate them to act more promptly by doing something to Taiwan. And if the states haven't deleveraged enough from Taiwan with chip reduction, the White House will have to intervene, and that could potentially mean a military conflict that also comes with a tail risk of spilling over into something much bigger, as neither side will want to back down, as the stakes are just too high. Xi Jinping has stated the reunification of Taiwan with the mainland as a very important, if not the most important, item on his agenda going forward. So I think the risks there have definitely risen, but I think going forward, the White House lets these tariff reactions play out. Like I said last week, they're okay with the markets tanking, may also help them with their goal and getting rates down. This could be all premeditated. Let all these other countries feel the heat, get very nervous of what's going to happen to their economies. Their markets are tanking just as badly now. No doubt all the current leaders are facing a lot of political pressure over there to get deals done, but I think maybe in say a month or two, he may invite all these countries to Mar-a-Lago. And instead of negotiating deals piece by piece with 80 plus countries, it's much more simpler just to bring them all over to Florida, get them at Mar-a-Lago, create maybe the Mar-a-Lago Accords, in which, like I said, new global trade deals will be written and signed heavily in favor of the states, dramatically tipping the balance, causing a lot of the world to deleverage from China, taking away their huge export advantage, trade surplus, which has definitely helped make their country richer and richer over the past 10, 20 years. The White House is right about that, and they no longer want to finance their biggest competitor and threat overtaking them. Because me personally, I don't buy this whole end of US exceptionalism. No doubt this is definitely a huge shakeup in the heat of the moment here. But the White House is going for it and they're not backing down. And I don't think this president wants to go down in the history books as the one who permanently crashed markets, triggered a massive recession, and America ended up coming out of this as a loser. Also don't think he wants to lose the midterms either. He's a negotiator, been involved in over 3,000 lawsuits in his lifetime, plenty of experience with battling others. And I believe it's an old school negotiation tactic, starting out with such an outrageous demand to shock the other side into settling at what they wanted to achieve to begin with. Because as I was saying, I don't think these extreme tariffs are sustainable for the world nor the states. There is going to be a need for low-cost labor going forward. You can't replace every factory out of Vietnam, Thailand, Indonesia, and Malaysia, and China for that matter, in the States overnight. That takes years, let alone the amount of materials required, and you've still got high-cost labor. I just don't think it's possible. And plus, we're going into the future of robotics and automation. But look at these rates on Vietnam, 90%, Thailand, 72%, Indonesia, 64%, Malaysia, 47%. Higher than what he slapped on China to incentivize them to really come to the table and get deals done, whilst tariffs from China might actually not only stay but go up, really put the squeeze on them hard. Anyway, that's just my theory about all this. I'm interested to hear what you think about all that. Let me know in the comments below this video. Because we've got other countries already really keen to get deals done. Israel said they're not only wipe all tariffs, but they want to eliminate the trade deficit with the state. Japan's ready to come to the table. Even the EU said they're ready to negotiate, with the EU Commission President signaling they're potentially ready to offer 0 for 0 tariffs for industrial goods, because Europe is always ready for a good deal. But as I was saying, the key will be countries like Vietnam. They have the potential to really come out ahead of all this and help replace China as the home of the world's low-cost manufacturing. And that's why, even though they've come out and said they're willing to drop tariffs on US goods, the White House is not just saying, come on over and sign the paper today. They're pushing back, playing hardball, saying, no, we want you to drop all trade barriers. We're really going to squeeze you for the best deal possible, which I think will end up happening. But for the here and now, no doubt a lot of people are freaking out, economists included, saying the slowdown's already begun, we're headed for a sharp downturn, layoffs will surge. Even Goldman Sachs raising their recession probabilities now to 45%, saying it's coin flip this year whether we get a recession, which is still possible, don't get me wrong. And if we do, not only do corporate earnings come down in a recession, but so do valuation multiples. Investors get less excited about owning stocks. Current forward PE on the S&P as of today's close is about 18.5, 19. Looking back in history, when we do have deep corrections and recessions, forward PE can often bottom out around 13. So for sure, if we do go into a recession, the S&P 500 likely hasn't bottomed out yet. Even the CEO of Wall Street's largest bank, Jamie Dimon, also sounding the alarm bells. Worried about inflation and slow growth, stagflation. CEO of the world's largest asset manager, Larry Fink, said we're probably already in a recession, but don't sell your stocks just yet. Saying the market could decline another 20%, but in the long run, this will be more of a buying opportunity. Even Stanley Druckenmiller, famous billionaire hedge fund manager, came out on X over the weekend and a very rare tweet. He's only ever made 5 tweets in his life and said, I do not support tariffs exceeding 10%, which I made abundantly clear in the interview you cite. Howard Marks, also brilliant hedge fund manager, said tariffs changing everything. biggest change of C in his entire career, going on to say global trade was the biggest driver of prosperity in the last 80, and that if these tariffs persist, inflation will skyrocket, which I agree with as well. They're not sustainable. It's currently a time of dislocation. That's true for sure. It's not a time to be fearful. Much easier said than done in practice. But he still believes the States is the best place to invest. Then billionaire hedge fund manager Bill Ackman appeared to get a little emotional heat in the moment, lashed out at Secretary of Commerce Howard Lutnick over the weekend, accusing him and his company of being long bonds, saying that he profits when our economy implodes, for which he came out a few hours later and said it was unfair and dialed back his remarks. We got others like Mart Spitznagel, longtime doomsayer, and Tesla Permabear, thinks it's far from over. Stock market's going to go down 80% by the time this is said and done. And the recent plunge is just a trap. But it's not just stocks getting created, also crude oil has come off a lot these last couple of days. Big spinning doji to start the week off, just like stocks. And you know it's a bit of a liquidation event when even gold came off hard as well. But where was Jay Powell amongst all of this? Well, he came out with a softly spoken speech on Friday, pretty much just walking the line again. No Fed put. Maybe he's okay with the markets getting tanked as well, as he knows rates for the states have to come down. Got a huge debt bill to pay off. Private governments racked up trillions of dollars over the past 20 years fighting around the world. Maybe those chickens finally coming home to roost. But you can bet they're watching this closely. Could be on the edge of getting the Fed put if we see any further splits in credit markets, which have been cracking as well. They did hold a closed board meeting today, I can see on their website. So we could hear something from the Fed this week if markets can't find their feet quickly. And just a few more things before I show you my options trades. If your portfolios are down a little bit this year, don't feel so bad. So are the portfolios of the richest people in the world. But of course, standing out there, the true outlier this year, Warren Buffett, and no doubt he deserves an honorable mention for getting almost 30% of his portfolio into cash coming into this. Because looking at some of the other most richest people in the world, their portfolios are taking heavy dives here as well. And all this is happening on the cusp of a new earnings season, actually kicking off this Friday. We'll get to hear from all the big banks, JP Morgan, Wells Fargo. What are they going to come out and say? Then starts dialing up a bit more next week. Then it's always typically the third, fourth week of the first month of the quarter. We get into the thick of it. Okay, I thought I'd share with you guys a few options trades I made last night as soon as futures markets opened on Sunday night. Just looking at the 5-minute chart here of the E-mini S&P 500. There's the regular trading session. You can see we're actually just drifting up a little bit after hours here as I speak. Wild day of trading, massive 400-point range for the E-mini. But just going back to pre-market here. And so that's where we closed on Friday afternoon, just under 5,100. And that's where we opened last night, Sunday night, when futures opened. And I've seen this quite a few times before. There's just such a huge queue of sell orders, everyone freaking out that we do a massive gap down, those orders fill, and everyone's watching futures open, can see they're tanking, just confirms their fears, then a whole lot more sell orders come in. And we kind of got that capitulation all within the first 5 minutes. The market's kind of found their feet. And so I'm sitting there watching this, and I'm looking at the only options market that was open. That is options on the E-mini futures. And implied volatilities were off the charts. In fact, I saw something I've never seen before. People were buying doomsday insurance. There was a market for options for the S&P 500 to drop 20% today. Something that's only happened once before in its entire 75-year existence, Black Monday 1987. As we can see here, the next biggest down day was March 2020, 12%. Then in the Great Depression, we had 10, 9.9, another few big ones in 2020, GFC, week after 87, and so on. Such a rare occurrence. For the market to even close down more than 6%, it's only happened 10 days before in history. But here's the thing, since 1987, we've got what's known as circuit breakers. The S&P falls 7%, trading gets halted for 15 minutes, but that's the only one effective outside of cash trading hours, official market open. Inside trading hours, we've also got 13% halt that stops trading for 15 minutes, but if we're down 20%, trading is done for the day. Now, whilst technically that was possible pre-market, it's never happened before. 1987, we finished down 20% by regular close. But like I said, there was options being bought for the S&P 500 being priced down 20%. And so just looking at the daily chart of the E-mini here, we'll just have to zoom out for a bit to see this. So 20% from Friday's close of about 50.96 would have meant the S&P would have had to fall down to 40.76. Like I said, there was decent bid and asks, time value on options on these strikes. But that's the worst day the market's ever had, 1987. The next worst day was down 12%, which would have taken us to about 44.60, say around 4,500, which I got to tell you, coming in on the heat of the moment, Sunday night, big gap down, everyone's talking. I was starting to wonder myself, is this it? Are we going to see the big one down 10, 12%? And even though I thought that was a possibility, I just didn't think we would go further than that. And if we did, it wouldn't last for long. Maybe a crazy intraday spike down before we did get some sort of Fed put or the government step in. But in my mind, it was practically impossible for the market to finish down over 20% because the market would have been halted by then. And so as you guys know, I told you on Friday, I put on a bunch of iron butterflies, basically selling volatility on 5 different stocks. Surprisingly, they're a little bit in the green today, even though volatility shot up, applied volatility shot up to get a little bit of some sideways movement, which helps the iron butterflies. And I'm expecting a bit of a volatility crush at some point this week, along with earning huge daily theta, which should help out those butterflies. But as I said on Friday, I was keeping more dry powder to do more butterflies today, along with some other trades. I wasn't really planning on trading E-mini futures when they opened, but I couldn't resist the opportunity with the numbers I was seeing. But I was wondering, are we going to get that big one? So I didn't sell as many contracts as I normally would. Didn't want to go full port, even though it felt like I was just collecting free money and I needed to keep some dry powder. But still, the E-mini contract is $50 a point. And so I thought I'd better turn it into a vertical just to be a bit more safe and also help to free up margin, because when you do naked puts, it requires a lot more margin than a vertical. The margin for the vertical is only its max loss. So on 0 days to expiry options that expired this afternoon, I sold the 43.50 put, which is actually about 14.6% below Friday's close. Then to protect myself and lower my margin, I bought the 41.50 put. That's what's known as a bullish put spread. Sell on the high strike, which collects more premium than what you have to pay for the protective wing. So that brought in $11.50 in credit per contract times $50 multiplier, works out to $1,150 and net premium received. And I ended up closing the spread but an hour before market close for 5 cents. So I made a bit over $1,100 on that one, but I couldn't help myself. I also went straight for a naked put, selling tomorrow's expiry, the 4,000 strike, which I couldn't believe was at $13.50, implying almost 180% implied volatility. Keep in mind, the S&P 500 actual realized volatility on an annualized basis is about 13-14%. That's why the VIX averages a little bit higher, about 16.5 volatility risk premium baked in there. And I've never seen anything like that before in my career. It was trading like some tiny biotech stock with a pending FDA announcement, but it wasn't. It was the S&P 500. And so I sold a 4,000 strike expiring tomorrow, which would have meant about a 21% decline from Friday's close. And I was happy to go naked because I thought, well, if we close below that, it can't be too much lower. Definitely going to get some sort of Fed or White House put, and I'll just eat the intrinsic value on it. But I thought if we even did do that crazy spike, it would only be temporary. And that's why it kind of felt like free money. And even on the vertical, the IV on that was above 160% on the put that I sold. Crazy. Even with the VIX at 60, it was just a massive volatility smirk, which means the IVs for out of the money puts was so much higher than at the money. And in hindsight, of course, I probably should have gone a bit more aggressive and sold a few more contracts. But nonetheless, both these trades brought in $1,800 in net profit after I closed them out both this afternoon to free up some margin instead of just letting them expire. So as I've been saying, it's a great environment to trade options. Volatilities are crazy, there's dislocation, and it's not just a matter of there's dumb people buying that doomsday insurance, it's more a matter of constraint in the market, dislocation, liquidations, margin calls. I probably did trade with a market maker, but because the whole volatility smile was so elevated, they probably still made their quick arb on the trade as well, arbing me against other options in the curve, delta hedging and whatnot. And so that's something I'm not sure if I'll ever see again, but if I do, I'm going to go much more aggressive. But as I was saying, even in the heat of the moment, I was starting to scratch my head and think, maybe we do get a big 15-20% down day. Hence why I had to limit my risk somewhat. But anyway, if you got any questions on options, let me know and come back for tomorrow's video. I'll do a basic option tutorial on cash secured puts and covered calls to help explain those basic option strategies. And if you want to get my volatility heat map indicator 100% for free on TradingView, then just click the link below this video or head on directly over to my website, clickcapital.io/volatility. Enter your email, TradingView username, give us a few hours, and you'll get my new volatility heat map indicator added to your account as well. Okay, just a few more things before I wrap it up and give you my summary on the market, along with some other thoughts. Just a quick update of what's going on in the world of robotics this week. And just because of all this market fears, crash, tariffs, things are still progressing. OpenAI just closed a $40 billion round of funding, giving them a valuation of $300 billion. Figure AI, humanoids, are now operational on BMW's production line, actually performing real work. This has already started. Amazon AGI Labs dropped an overact an AI agent system that controlled browsers to perform tasks. Vancouver-based Sanctuary AI demoed their efforts with simulation to real transfer. And XAI acquired X, creating a joint entity with a $113 billion valuation. And Runway released Gen 4, next generation video generation model. AI is just growing leaps and bounds with imaging and video, not to mention in the physical world as we approach artificial general intelligence. AI goes from understanding language to the world around it. Not to mention cool stuff coming out with Google and Gemini, actually starting to lead the pack with scoring on their LLM. And much more stuff is still progressing in this space, including one of my favorites, Rich Tech Robotics. Their Atom bot was a hit with Rangers fans this weekend, serving up drinks at the venue. With the stock actually closing higher today, had a bit of a gap down and finished above Friday's close. Okay, just wrapping it up and just a few thoughts. Big spinning doji here on the market. Look how extended this whole candle is below the buy-sell band. One of the most technically oversold markets I've ever seen in my career. But don't get me wrong, I'm still a perma bull long term. I haven't sold any of my long-term positions. I've actually been adding to them. And I know I was super bullish just 6 weeks ago. I mean, the market was hitting all-time highs. It's the most bullish signal we can get. And don't worry, when the market does eventually get back to all-time highs, I'll be the most bullish guy out there. But as I've been saying, we can't ignore this tectonic change happening in the global economy, the fundamentals, government policy. It's still very much up in the air. It's no surprise the VIX is so elevated. It's likely to remain so for some time. I'd be surprised to see the VIX back under 20 anytime soon. No doubt we will get that volatility crush at some point, but who knows, 24, 22 could be the new floor for a little while. And just going out to a monthly chart, typically when we get these volatility uncoiling episodes, it can set up for higher volatility regimes that last for some time, like the GFC. Kind of uncoiled, and it was actually a couple of years before it went back into a low volatility regime, which it stayed there for a few more years. Then when we get a big spike, kind of just takes it into a high average for another couple of years. I think we may have just gone into that, and why I think volatility has been made great again. It's awesome for option traders, and hence why I'm talking more about it and happy to teach you guys more about it, as many more of you are asking me about this stuff. Gives the opportunity to profit even if markets are going down or sideways. Not to mention exploding volume options, the huge growth of zero DTE and weeklies. It's why I've been doing a lot more options trading myself this year. But as I've said many times before, when it comes to the markets, I don't have closely held convictions. I have loosely held theses, which are supported by data and the market trends. But a lot of us, myself included, were caught a little bit off guard by how dramatic and extreme these tariffs that have gone into effect really are. And this happens to the best of us. Even billionaire hedge fund manager Bill Ackman, he's got 250 plus professional analysts, data scientists, PhDs and quants working for him. Do you think if they saw what coming, they would have invested over $1 billion into Nike a couple of months ago? The stock's been absolutely trashed by the threat of huge global tariffs. The answer is no. He's feeling the heat, just like plenty of other billionaires are as well. All of our portfolios have gone into drawdown. That's why you got to be careful using leverage, because that's how you get margin called and blow up. Really hard to recover if your portfolio takes a bigger than 50% drawdown. So we will get through this, recession or not. I'm up for the challenge. We just got to adapt and try and turn lemons into lemonade. I'm doing my best I can, and I know you guys are as well. So thanks very much for sticking with Click Capital. I'm always interested to hear your thoughts. I read every comment, and I'll be back this time tomorrow, like I said, with an option tutorial going over cash secured puts and covered calls for those that are interested. Otherwise, I'm sure we're in for a big week, and I'm interested to see whether my game theory plays out with these whole tariffs, which the president could let these countries still sweat it out for a few more weeks, make them not sure of what's going to happen. Then he might invite them all to Mar-a-Lago, get one big deal done, bar China. That's how I'm reading it all right now. But of course, we're in a very dynamic, fluid situation with things changing dramatically day by day. On top of that, we've got CPI inflation coming this Wednesday. Core inflation expected to come in 3% year over year, 0.3 month over month. But right now, the market's really trading on extreme sentiment and liquidity. And it's not too often you see a daily candle like this on the S&P 500. That's all for now. Thanks very much for tuning in, and I look forward to breaking it all down for you again this time tomorrow. Cheers.